So at least majority of the part which is relevant for our discussion, that is what we will try and complete today. So bond convexity is one point. Then subsequently we'll talk a bit about uh, what you call as a LIBOR transition, so something which has happened recently. So by the time you guys join the industry, you'll have new benchmarks to work with. So what are those benchmarks and why exactly that has happened, we'll understand as well. And generally, understanding the way in which you classify fixed income securities in a bank's book. So that is also something which we'll discuss along the way, and some bit on asset securitization. Because if you recollect, the last time we had introduced ourselves to the ideas of ABS and MBS very briefly. So at that time, I had mentioned that we'll cover this in detail when we cover asset securitization. So that is something which I plan to finish today. I don't think we'll be able to start FRA today, but if possible, we'll at least do some basic discussion on FRAs, but valuation of FRAs, or how exactly do you understand how much a FRA is worth at a certain point in time. So that is something which we'll do in our next class. So let's see how time permits today. Okay, so we discussed duration the last time. Now we'll take a step ahead and we'll understand convexity. So convexity is just a second order differential. So if you recollect, we had written duration as something as dp by dy, where p was the bond price, y was the yield. Now for convexity, you can imagine this is a second order derivative. So it is d2p by dy square. So when it's a second order derivative, the advantage or flexibility which convexity has is it understands the curvature which is there in a price versus yield chart. So a typical price versus yield relationship, we are aware it is something like this. And for duration, like we discussed the last time, we look at a very small change in yield so that we maintain the linearity between, let's say, points A and B. Now, if you have a larger change, so something like a X and Y, if this is the amount of change which you are planning to make standing today, so let's say this is today, let's say this point O is today. So if I want to make a larger change from O of either to X or to Y, that is a significant movement which happens. And when there is such a large movement which happens in a yield, then naturally the curvature is something which needs to be factored in. So that is something which convexity helps us capture. Now, normally you'll observe that convexity is something which is not really tracked by traders or risk managers, because if you're working on mainly plain vanilla bonds, which is majorly the case. So when I say plain vanilla bonds, that is bonds without any kind of options. That is, you don't have any kind of call or put options embedded on the bonds. So in such a scenario, you don't really have to go in the convexity way, because convexity is something which will not really enhance your analysis to a significant extent. So most of the times you are going to end up using duration, and that will be your metric to approximate a certain change which is happening in a bond price vis-a-vis a change in yield. But if you happen to join a desk which is specifically working on structured products, whereby you have bonds with optionalities, or maybe if you're transacting in MBS or ABS types of securities. So in India, we don't really have an active market for securitized products, but if you join a firm abroad and if they are specifically dealing in securitized products, then yes, you will have to factor in convexity as well. Because for those type of products, wherever you have a bond plus an option, just using duration may not be a decent enough approximation. So at that time, you have to combine duration along with convexity. So once you combine these two measures, it will give you a good enough estimate for a callable or a puttable bond, or maybe something like a MBS or ABS security as well. But otherwise, if you're mainly working on bonds which are plain vanilla, which is majorly the case, because if you observe the portfolio size, majority of the portfolio is parked around plain vanilla bonds. So that's where duration is good enough. You don't really have to worry much about convexity. Now, many banks in India don't really have any policy on convexity as well, because they simply don't track convexity. It's not required. But maybe abroad, for certain desks, they may have a certain policy which focuses on convexity. But otherwise, it's not a very frequently used measure, I would say. Duration is good enough. So duration, it could be used for your basic risk measurement. It can also be used for your capital charge calculations and any other related measures. So that way, I would say you should spend more time on the duration bit rather than convexity. As and when required, convexity is just a step ahead. So something which you have done for duration, you have to just apply it for convexity. So it's not very difficult, but not a very widely used concept as compared to duration. Now, why we say it's a non-linear measure? Because if you look at this relationship, this is a second order relationship. And whenever you have a second order thing, this becomes non-linear in nature. Because the duration equation, dp by dy, this is a linear relationship because we have a first order derivative. And when I say a first order derivative, that is something which I can show via a simple straight line. So something like our normal definition of slope of line, which we had studied in high school. But for convexity, that is not the case. And now again, convexity brings with itself a few advantages, which is more flexibility because you can track curvatures. So that way, if you want to estimate what will happen for larger change in yield, you may have to factor in convexity. Again, the behavior for bond with embedded options is different whenever you factor in the convexity bit. So that is where convexity plays a role. But in a business as usual scenario, yield changes are not that great. So if you observe day over day, you'll hardly have maybe 1 or 2 basis points change in yield which happens. In very rare circumstances, do you see a change in yield close to 7 or 8 bips? That is considerably large. So that rarely happens. So in most of your business as usual scenarios, I would say duration is a decent enough estimate, and most of your risk engines and risk systems will be tracking duration. There may be a facility to have convexity, but I don't expect this to be tracked too much as compared to duration. Then there is an idea which we call as duration gap. So when I say duration gap, this is nothing but the duration of your assets and duration of your liabilities. So can you guess why this gap management is important? Why do I need to manage duration of assets and duration of liabilities? What could be the reason behind that?
So cash management cycle.
Okay, okay. Anything else? So anything from maybe your balance sheet management side of things?
So liquidity management.
Correct, correct,
So
correct,
data collection or a sort of turnover from that.
correct, correct. So basically, all of these things point us to what we call as balance sheet management. So you must be introduced to the idea of financial statement analysis, right? So did you guys have an introduction to income statements, cash flow statements, balance sheets, etc.? So was that covered as a part of your other subjects?
Yes, sir.
Okay, okay. So when you talk from a balance sheet perspective, you basically have assets and a liability side of the balance sheet. So a quick question is, so when you say uh, it's shareholder capital, is it an asset or is it a liability?
It's a liability.
Okay. So basically, I mean, just a quick question. But otherwise, for banks as well, balance sheet management is immensely important because your assets and liabilities have to move in tandem with each other. Because if not, then that can have a lot of funding mismatches, which can cause problems in the long run. So, so what banks generally do is they have a certain threshold which is defined for a duration gap. So they will. So ideally, everyone would want the duration gap to be zero, but practically it's impossible. You cannot have a gap to be zero. But you'll try to have this value to a very, or you try to bring this gap to the lowest possible value which you can, because the lower this gap, you can say you're better managing your assets and liabilities position. And whenever that is the case, your funding gaps or funding mismatches are under control. Because the thing is, you should, so the idea behind duration gap analysis is to ensure that whatever liabilities you have, you are earmarking your assets accordingly. That is, if you have a liability which is maturing in, let's say, 1 year's time, let's say it's maturing in 365 days time, then you would ideally want a certain asset which is maturing in, let's say, 360 days. So my asset gets ready in, let's say, day 360, and my liability is coming due in day 365. Now, this I would say is a very good way of, or a very good example of duration gap analysis or management, because there's barely any difference between these two. Now, a 5 day gap is nothing. Now, if you compare this versus, let's say, a duration of my asset is just say 30 days, whereas duration of my liabilities is 365 days. So that means my assets are getting ready in 30 days time, but my liabilities are coming due only in 365 days. So that way, if you see, there is almost an 11-month gap between the time my assets are ready and my liabilities are coming due. Now, this I would say is a not very preferred way of uh, managing your balance sheet position, because that way your funds are going to remain exposed to a significant amount of interest rate risk, because over the next 11 months there can be considerable uncertainty as to the way in which the interest rate environment is going to change. And whenever that happens, naturally your funds which are getting ready in 30 days will be exposed to that kind of interest rate risk, and it may so happen that these funds may not be good enough to meet your liability requirements on day 365. So this, I could say, is a bad example for ALM, but this can be considered as a good example because your duration of assets and liabilities are very, very close. So your funds do not remain at risk for a very long time. In 5 days, you do not expect a significant movement in rates. So that way, your funds will not drop in value too much. So that way, that funds can, which are earmarked for meeting this liability coming due in 365, that would meet your requirement. So that's why every bank is going to try and manage their balance sheet position. So again, duration gap analysis will be a part of your ALM policy. So if you recollect, we had discussed about various policies. So even as a part of your ALM policy, you'll have other things, something like behavioral modeling, etc., and you have this duration gap analysis. So this threshold might be defined. So your management will say that we are okay with having a duration gap up to so much, so much. So that threshold is something which will be continuously monitored by ALM teams, and they will always try to keep that gap to the minimum. And if there is a breach in the gap, then they'll have to give a rationale as to why that gap has breached. So that's how you can look at duration gap analysis. So any questions on this slide?
So, what is the ideal gap to say in terms of asset liability management?
Ideally zero, but zero is not practically possible. So you try to keep this gap to the minimum level as possible. So that way your trading team can take the required actions, or your balance sheet management traders in the front office, they'll take required actions to ensure that this gap remains to the minimum.
So, to prevent,
Any
loss of potentially.
any mismatches in your funding sources.
So, because it's basically idle money lying without earning anything.
Something like that. Yes. And also you're risking your money unnecessarily to interest rate fluctuations, which you don't want.
Okay, so
So a related policy to this ALM policy, definitely, but there are other guidelines from the regulator which they also call as IRRBB, which we call as interest rate risk of the banking book. So this is something which comes under your ICAP. So ICAP is something which is required by every bank, which is Internal Capital Adequacy Assessment Program. So ICAP is, so have you guys been introduced to the three pillars of Basel? So Basel 3 circular talks about three pillars. So have those been discussed in your maybe financial institutions or any other subject? Okay. So pillar one mainly talks about your capital. So pillar one mainly talks about capital. Now, guys, just a second. I'm getting a call. Can I answer that? Hello. Hello. हाँ हाँ मॅडम. हो 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 ते फक्त आज परत येतो म्हणले होते मला, कारण एकाच बहुतेक ते म्हणले की थोडं त्यांना एक्स्ट्रा काम करावं लागणार आहे एका ठिकाणी, तर आज त्यांना पाठवता येईल का? हा हा, तर ते म्हणले की एकदा तुम्ही परत कोऑर्डिनेट करा ऑफिस बरोबर आणि ते आज येतील, तर आज आज जमू शकेल. Sorry, guys, I had to take that call. So basically, three pillars for Basel. You have your capital on the first. Then second is mainly talks about your capital charge computations, etc. So things like your market risk, or maybe the three types of risk, which you call as market, credit, and ops risk. And third is what you call as the supervisory review. So under supervisory review, you have a section on ICAP, which is Internal Capital Adequacy Assessment Program. So this is more of an overview of the entire capital adequacy framework for any bank. So every bank is required to adhere to the ICAP principles. So that way, every bank will have a policy around ICAP. And things which we are discussing now, ideas of duration gap, ALM policies, IRR, BB, etc., everything gets covered under ICAP. So every bank needs to have an independent team which does the ICAP for them. At the same time, bank may hire external consultants time and again in order to review the appropriateness and adequacy of the ICAP procedures. So in case if there are any gaps, that is something which the consultant is supposed to point out. So along with ICAP, there is additional guideline which we call as a ILAP. Now, ILAP is something which RBI hasn't really insisted on, but ILAP is something which has been adopted by the Eurozone regulators. So this is Internal Liquidity Adequacy Assessment Program. So one guideline talks about capital, other guideline talks about liquidity. So ideas of LCR, NSFR, or things like behavioral modeling, etc., everything gets covered under the broader gamut of ILAP. So that way, these two are regulatory requirements which every bank needs to fulfill. And finally, I mean, this is a comprehensive framework. So within this, you have a variety of things which go in. So ideas of modeling, capital charge calculation, stress testing, scenario analysis, collateral management, or maybe how you're managing your liquidity positions, etc. Everything gets comprehensively covered under both ICAP as well as ILAP. So maybe whenever you do get a chance, you can generally go through the ICAP guidelines. So RBI has a guideline on ICAP. So if I recollect, this is a part of the Basel III guideline. So Basel III circular, which the RBI has published, and if I recollect the date, something which I had referred to recently. So I think it was July 1st or something, July 1st, 2015. So I think it's roughly dated around this date. But again, a very useful circular which talks about the three pillars of capital requirements, and it will talk about supervisory review plus ICAP as well. I don't think it has ILAP because RBI has not pushed for ILAP yet, but gradually there may be a requirement on ILAP as well going ahead. Any more questions? Okay. So the thing with these guidelines is you can generally browse through them and you don't have to remember them. It's not required. You can refer to this guideline at any point in time. But having familiarity with these guidelines is helpful because if you join risk analytics within a bank, then you will be expected to read through this guideline and interpret what the guideline says so that you can implement those things in the system. Now, most of the things will already be there in your banking framework, whichever bank you join. But there may be certain enhancements or certain gaps which may need to be analyzed. So at that time, having familiarity with these circulars is helpful. I know reading circulars is immensely boring, but having an idea is always helpful. And so that once you have an idea, when you have to actually use them in practice, you know which section you have to look at. Otherwise, if you open the circular for the very first time, when the requirement comes up, then it can be a challenge. Then you have to figure out which is the correct circular. So it can start from there. So whether a certain circular is applicable, then if yes, then which section of the circular is applicable. So you can avoid that time delay if you generally browse through certain circulars now. Just skimming through is good enough because these are big circulars. So roughly 200 to 300 pages, if I recollect, is Basel III. But having a decent idea of these things is always helpful because finally, for any bank or a financial institution, the regulatory environment is immensely important. So they are very, very careful about anything which happens on the regulatory side of things. So if you have familiarity with these things, it is useful. Proceeding. Now, to give you an idea as to how a fixed income investment can be brought onto a bank's portfolio. So I've shown a rough chart here. This can be applicable for your investments or any kind of trading opportunities which your GMG might be looking at. So let's walk through this. So firstly, when you talk from the business side, you know that it's GMG, corporate banking or investment banking, which could act as the core business for the bank. So these are the teams which are always there to look at new revenue generating opportunities, and they would want to look at various options which are available at hand so that bank can make investments. So business will keep on looking at new potential opportunities which can be pursued. Now, naturally, every opportunity uh, cannot be invested in, right? Because finally, every bank will have limited amount of resources at its disposal. So when I say resources, limited amount of funds at its disposal. So it will not be possible to invest in every single opportunity which the business tracks. So what the management can do is it will look at various opportunities which the business has shortlisted. So let's say the business has shortlisted 10 opportunities of investment in fixed income. So out of 10, they may decide to pursue, let's say, three opportunities because they feel that these three opportunities are going to add significant value to the bank's portfolio. So three opportunities will be picked up. Now, they cannot immediately start investing because there is a process which is to be followed. Now, once these three opportunities have been shortlisted, then a comprehensive note or notes have to be prepared, which talk about each of the investment. So if we look at three investment opportunities, three different notes have to be prepared, and each note have to talk about various things about what is the tenor of investments, what is the face value of investment which they are looking at, what is the issuer, what are the ratings, also the rationale as to why they are making that investment, because rationale is immensely important. Unless the business can justify the rationale, getting clearance for these opportunities could be difficult. So rationale also has to be clearly mentioned, and all of this goes and sits inside a note. Now, this note which is prepared by the business will be sent to different teams within the bank, because we know that in a bank there are various teams which work together. So you have the core business group, then you have people from risk, you have compliance, legal, audit, etc. Now all of them work together for the smooth functioning of the enterprise or the bank in this case. So this note which is prepared is sent to the head of different departments. So GMG, corporate investment banking, risk, compliance, legal, etc. Now their inputs are taken because each of these teams will have a certain viewpoint as to what a certain investment might turn out for a bank. So everyone's inputs are taken into consideration. Any concerns which they have, they can be discussed as well before any kind of finalization of the note is done. So what happens is after this step, the note is again brought up for discussion because there may definitely be certain queries which are raised by someone. So maybe risk team could say that we feel that this particular bond investment is very risky. So we want you to have certain mitigants in place. Then maybe legal team may say that the entity with whom you are transacting, they have had a lot of legal proceedings in the near past. So we would generally be careful to tread that path. So we may not want to immediately transact with them, or maybe even if we transact with them, we would want to limit our exposures. So these can be concerns which can be raised by various teams. Now, once these concerns are raised, they will be discussed and addressed. Now, once they're resolved, that is, once you have a sign off from all of these authorities, then the actual process of onboarding that a particular asset on the bank's portfolio begins. Now, naturally, that onboarding cannot happen immediately because firstly, you need to have your enterprise risk system, which is tuned in order to hold that investment on the book. So, if I am looking at, let's say, a new bond investment, which I feel is a strategic, that is a long term investment for the bank, then what I do is I need to have the required system infrastructure ready. That is, let's say I may have to create a new placeholder for that security. So maybe I can create a new book. So when I say a book, imagine this like to be a trading book. So I create a new trading book. On that trading book, I have to set certain things like exposure management, which I call as limits. So we'll be talking of limits in our exposure monitoring module. So that is something which will come later. So for now, don't worry about limits. We'll understand what are limits, etc. But I'll also define what a holding period of my investment is. So on that book, I may have to define what is the maximum holding period which I'll be monitoring, because I may have a certain finite time up to which I want to stay invested in a certain security. So that's why definition of holding period is important. Also, I need to get my back office systems ready, because finally, once I start transacting in that product, so let's say I'm either trading a bond, or maybe I'm making a large lending, or maybe I'm looking at a strategic investment. Now, whatever actions I make, that is going to be a part of my portfolio. And back offices do something which they call as position reconciliation, position recon. So when I say position recon, it's a reconciliation of every position which the bank is holding. So your related valuations, your P&L calculations, your daily P&L numbers, etc. Everything is something which the back office calculates. So that's why even the back office systems have to be made up to date so that they can fetch this incoming security which will be getting added on the books. Once all of these things are done, then the actual transaction can begin. So either the trading can be done by the front office, or maybe a large lending might be done by corporate or investment banking, or maybe a, a strategic investment in a certain bond might be done by corporate and investment banking. So it is at that point in time that the investment actually comes on the bank's books. And once it gets on the bank's books, then risk has to keep on monitoring that position on a daily basis, because we know that risk monitoring is a daily activity. It's not like a static thing. So it's not like do once and forget. It doesn't happen that way. So every day, risk will have to monitor that position, and accordingly, they'll have to keep on monitoring either limits, exposures, capital charge, etc. Whereas your business will decide how exactly they want to manage that position. So when I say manage that position, it's mainly from a business perspective. That is from generation of profitability for the bank. So your GMG may decide to trade a certain security, or maybe your corporate or investment banking may say that, fine, we are done with this much amount of lending, but we feel that there is a potential to do some more lending, which may be profitable for the bank. So that is something which can happen as a follow up as well. So this is roughly a process which is followed to get a fixed income investment on a bank's book. And when I say fixed income investment, you can think of this from trading, or from large lending, or even from strategic investments perspective. So any questions on this?
So when you say the risk monitoring is done daily or periodically, what is exactly risk monitoring in this context of fixed income securities?
So risk monitoring on a daily basis can have a few points. So things like calculating your daily MTMs, then calculating your duration. Also, maybe considering this investment as a broader part of your ALM policy as well. So how exactly this is working in your ALM framework. Next can be your capital charge calculations. So on a daily basis, you need to monitor and calculate capital charge. This can be used for exposure monitoring as well. It can be used for risk analytics, that is, let's say, value at risk, etc. Also, maybe you may want to do collateral management as well based on this, because let's say if the MTM of the bond moves in a certain way, you may have an agreement with your counterparty saying that we need to hold some collateral. Rarely, I mean, collateral will be very rare in such circumstances, but if required, yes, I mean, that can be factored in as well. So I would say from a risk perspective, these are 5 or 6 points which will be used. So MTM we know, duration we know, ALM we have spoken briefly. Capital charge, exposure monitoring, value at risk, etc. we are going to study in detail in our subsequent classes.
So just one more thing, I did not understand MTM in this fixed income concepts unless we are holding an option. So there would be an MTM.
So you can do a mark to market for a bond as well, right? So if I'm holding a certain bond, I may want to know how much is the present value of that bond, because that is what I call as the market value for that particular bond. So if it's a traded price, then fine, I can use the traded price directly. If not, because not every bond is liquidly traded. So if I don't have a trade for that particular bond, I may have to use a certain model to price that bond. So through that, I can derive the MTM or the fair value for that particular security.
So like margin call basically.
So margin call would be different actually. Margin call is something which happens from your trading perspective. Now, when you say MTMing or you're calculating the fair values for a certain asset. Now that may be linked to the idea of margin call, but that isn't margin call. Now, if I'm simply holding a bond, I may want to know how much the bond is worth today. So let's say I hold a certain investment. I want to know how much is that value which I can mark on my financial statements. Because of that, I need to do the MTME or the fair valuation of a bond on a daily basis.
Okay, sir. Thank you.
Any other questions? Okay. So going ahead. So generally giving you an overview of fixed income portfolios which you'll find inside a bank's book. So firstly, SLR, non-SLR securities, this we are familiar. So generally, if I have to divide these things, and I think we have done the division already. So SLR is mainly government securities. But just to do a quick recap, so T-bills, T-bonds, SDLs, etc. Whereas non-SLR could be corporate bonds, bank or financial institution bonds, NBFCs. You could have commercial paper, you could have certificates of deposits, etc. So what is commercial paper? So this might be covered in your financial institution subject. So what do you mean by a CP, and what's the purpose of a CP? Anyone? Okay. So commercial paper is a short-term funding instrument for a bank or for any financial institution, and CP is used for mainly meeting your working capital requirements. So maybe as a part of your financial management, or maybe as a part of your corporate finance, you may be introduced to the idea of capital budgeting and working capital management. Capital budgeting or working capital management. So from a working capital management perspective, CPs are important instruments which are used to fund in the short term. So the maximum tenor for commercial paper does not exceed beyond 1 year. And generally, those entities which are having a good credit rating will issue a commercial paper, because the market will accept only those entities which are highly rated. Because whenever they're lending in the short term, they always want to invest in only those products, or they want to invest only in those companies which are having a good credit rating. That is where the potential of default is low. So commercial paper is a short-term funding instrument. Similarly, a certificate of deposit as well. A bank may issue CD. Now, CDs are something which are introduced only by banks. So CDs are something which can be purchased and which can be traded amongst banks as well, banks and market participants. But again, this is a sort of funding which a bank does. So when you talk from SLR and non-SLR perspective, this is how you can briefly divide a bank's portfolio, especially in India. Globally, you may have a few other products on the non-SLR side, because globally you have a much open economy. Now here, RBI has a lot of restrictions which are there on the types of products which can trade. Also at the same time, RBI basically knows that the depth of our fixed income market is not that much. So we don't have too many advanced products which are there in our fixed income space up till now. Hopefully that will change in the years to come. But for now, these are the things which you'll primarily observe inside any bank's portfolio. Now, security classification based on HTM, HFT, and AFS. So was this covered as a part of your financial statement analysis? So are you guys familiar with these terms? Held to maturity.
Hello?
Yes.
Okay, nothing, sir. I think my mic was Yeah, HTM we know is held to maturity, and
Okay.
HFTS. Only the terms were introduced. I don't think we went into detail.
Okay. Okay. So generally, your fixed income positions will get divided into three books, either HTM, HFT, or AFS. So there is a separate accounting treatment which will be given to each of these. So accounting treatment is something which we will not discuss, but something which you can explore at a later point in time. But to give you an idea of how do you classify securities between these, HTM, as the name goes, are those securities which you intend to hold till maturity. So you do not wish to trade them. So imagine that I'm purchasing a HTM with, let's say, 10 years to maturity. Then I intend to hold on to that security from now until expiry. I don't wish to transact or I don't wish to trade that security at all. So that's what I call as a HTM. Next is HFT and AFS. So held for trading and available for sale. These are basically your tradable securities. So these are the securities which you may want to trade at a certain point in time. Now, if your holding period is less than 90 days, you may want to classify the security as HFT. Whereas if you're planning to hold on to that security for more than 90 days, you will want to classify that as available for sale. So that's a classification between HFT and AFS. But that being said, both HFT and AFS securities can be tradable, so you can trade them at any point in time. So uh, buying and selling of these securities is possible. So that is something which your front office will actively do as well. Now, relating this with a concept of one-time transfer. So there is an idea. So maybe before we go to one-time transfer, one thing which we can quickly do a discussion of is those securities which are under HTM. They don't have to be MTM daily. That is, those securities which are sitting on my HTM portfolio. I do not calculate the MTM on a daily basis. That is, they are immune to any kind of fluctuations which are happening in the yield curve on a daily basis. That is no MTM here. We don't need to do MTM. I'll simply carry them at the book value which I had procured them at. Now, this is an advantage because whenever I say I'm not MTMing my positions, that means I don't have to worry about interest rate fluctuations. So that way, for HTM portfolio, I don't have to worry about the way in which my yield curve shape is changing. But that is not the case for HFT or AFS. Now, anything which is sitting inside HFT and AFS, you have to do a daily MTM. So maybe a daily MTM can be for your exposure monitoring, for your risk management, for your capital calculations, etc. But anything in HFT or AFS will be exposed to interest rate fluctuations. So as the interest rate scenario changes, my investment in HFT and AFS will change as well. So that way you can look at daily MTMing versus no MTMing required. Now that will help us relate to what will happen for this one-time transfer thing. So there is a concept which we call as a one-time transfer, which the regulator permits the banks to do once every year. So every year, a bank will be allowed to move a certain proportion of the security sitting inside HTM into AFS. So can you guess the reason as to why a regulator will permit one-time transfer? Why would this be permitted?
So
Anyone?
it's a safeguard to prevent market fluctuation or panic selling.
Okay.
So, excuse me, sir.
Yes.
Could you just explain what exactly is a one-time transfer? So once a year, it allows a bank to do exactly HTM to
So
AFS.
yes. So once a year, a certain portion of your HTM portfolio can be moved to AFS. That is, you can trade them once it sits inside AFS.
But
Of
sir,
course, that would
isn't it just a nomenclature change? Just
not really, because if you see, HTM is not tradable, but something which is in AFS becomes a tradable security.
right, sir. Right. All right.
So what could be the rationale, anyone? And why do I really want to do one-time transfer?
So may, maybe it helps the banks to secure the right kind of securities. I mean, hold the right kind of securities, and becomes, as Mihir said, a safeguard.
Okay, okay, correct. So just adding on to your points, you are right. So the third thing is RBI would allow banks to capitalize on any favorable interest rate movements which have happened, because Even RBI knows that banks may want to earn certain profits based on the movements in interest rate which have happened over a period of time. So that's why this one-time transfer will allow a certain portion of HTM to be moved into AFS. Now, I don't recollect the exact amount of securities which can move from HTM to AFS. That is something which you'll get inside the guideline. But certain portion, once it moves inside the AFS, then it becomes like a tradable asset. Now the bank, once you see this movement done, they are free to trade anything which is inside the AFS book. Now, what will happen as a result is you will also see an upstick in the capital charge number. So let's say today on day T, I have calculated my capital charge as, let's say, 100 crores. Just taking some hypothetical number. Now, how capital charge is calculated, etc., we'll discuss in our subsequent sessions. But for now, imagine that my fixed income capital charge is 100 crores. Now, I have gone for a one-time transfer today. That is, now imagine tomorrow it is T plus 1. This capital charge may suddenly jump up to, let's say, 110 crores. Now, this is a large change. So 10 crores is not a very small amount. So this is something which you can witness whenever you move things from HTM into AFS, because we know that as long as things are sitting inside the HTM portfolio, you are not supposed to calculate the MTM on a daily basis. Accordingly, HTM securities do not attract any capital charge. You're not supposed to allocate capital for HTM securities. But for AFS, yes, anything on AFS or HFT, you have to allocate capital charge for that. So the moment you move certain quantum of securities from HTM into AFS, you'll see such a movement in capital charge happening as well. Because now the bank is carrying additional risk on its trading book, isn't it? Because certain portions which were sitting inside HTM, which were safe and secure, those have been moved into AFS and they have become tradable assets. Now, when I say tradable assets, they are exposed to interest rate fluctuations and also the market demand and supply. So that can have an impact on the overall price for that particular security. And that price will have an impact on overall capital adequacy for the bank as well. So it is because of this that you'll see a sudden jump which happens day over day whenever such a movement happens from HTM into AFS. So any questions on this? Overview of capital charge. I think this is something which we'll park for now because we discuss capital charge in depth in one of our subsequent bits, so that we'll discuss a few things which are specific to your overall regulatory framework. So things like CBA, capital charge computation, off-balance sheet exposure, etc. That is something which we'll cover later. So request you to park this point for now. We'll talk about this later. There's some message in the chat. No, Shubham has raised it. Yeah, Shubham, please go ahead.
Sir, my question is, does RBI allow transfer from AFS to HTM as well?
Yes, so there is a guideline on this as well. Certain portion can be moved from AFS to HTM also. Yes. But if you see proportion wise, the movement from HTM to AFS is always bigger as compared to the other way around.
Okay, sir.
Again, providing for illiquidity, I'll just give you an idea. Now, how exactly that provisioning happens, that is something which we'll cover when we talk of the capital charge framework. But there is an idea of provisioning for illiquidity. So can you guess what could be the reason behind this provisioning? Now, why do you require provisioning for illiquidity? What is the kind of risk which I'm trying to manage through such a provisioning? So when I say provisioning, imagine that I'm doing capital provisioning. So what could be the reason behind that? Okay. So a simple question which we try to answer through provisioning for illiquidity is, if I have to offload my illiquid bond positions tomorrow, then how much is the cost that I'm willing to pay? Now, when I say cost I'm willing to pay, that is the price hit which I am looking at. Because not every bond which I hold on my book is liquid. Now, there will definitely be illiquid securities. Now, for government securities, not a problem. They are very liquid. But there can be non-SLR securities which can be illiquid. So corporate bank or maybe NBFC bonds which do not carry that much amount of liquidity. So if there is an illiquid market for them, then offloading those securities can be a challenge for me. So let's say as per my model, let's say I have one illiquid security, and as per my model, I feel that the market price for that security should be 95 on a face value of 100. Now this is my model price, let's say. And I have confidence in my model and I feel this should be the price which I get. But tomorrow when I go to the market for actual transactions, I'll find few counterparties who are interested in this because I know it's an illiquid security, right? So there will not be too many takers for this. So the market may say that we will be willing to trade only at 85. Now, nothing more. Now, we don't think it is worth 95. We are fine with 85. Take it or leave it. So this is like a price hit. That is a loss of 10 rupees from my estimation. So this is for one bond. Now, I may have multiple units of this bond which I may want to offload. So that way, I may have to make a certain provisioning so that any kind of capital hit which I take because of this price hit, because finally this is a loss for me, isn't it? I'm losing 10 rupees on this trade if I go through. So this 10 rupees is a potential loss for the bank. So I need to make required capital provisioning so that I can handle any kind of such illiquidity shocks because of my specific positions in bonds. Now, how exactly does a bank follow capital provisioning for this? This is something which we'll cover subsequently. But is the idea of making capital provisioning for illiquidity clear? Is that much okay? Any questions on that? Okay. Okay, we are at securitization. What's the time? 12:25. So do we take a break for 5 minutes, or do we compare asset securitization and then take a break? So can we continue for like 20 minutes
So
more and
let's
then take a break,
continue and
or
then
should we take a quick tea
break.
break now? Okay, okay, all right. So talking of securitization. So when I say asset securitization, what comes to your mind? What could be this terminology? Now you must have seen movies which are made around securitization. So what could be the idea behind securitization? So benefits I've already
Basically,
enlisted
selling
here.
it off.
Okay,
A
so
fancy way of saying that we're selling something off.
okay. Anything else?
Sir, we can say selling of security as a collateral, like debt obligations or home loans or etc.
Okay, okay.
Uh, Sir, are you asking in the context like REIT and INVIT?
Sorry, which one?
REIT and INVIT, are you asking in that?
Something similar, yes. So that is more specific to real estate, but this is more generic.
Okay. So then SPV only comes to my mind. That is the basic method of, like I said, securitization.
Correct, correct. Okay. And any movies which you can recollect, which are based on asset securitization. Now, this term actually became notorious during the financial crisis as well, during the global financial crisis.
Big Short.
Correct. Big Short is there, margin call is there, etc. So good. So I mean, the idea behind asset securitization is to basically offload securities which are sitting on your books. So this is also what we call as originate to distribute model, technically. So under asset securitization, what a bank does is it will try to offload a portion of its loan portfolio to the broader market. So let's say I have a loan portfolio of imagine 100 crores. Let's say imagine 100 crores is a large amount. So I have a portfolio worth 100 crores right now. This is my loan portfolio. Now, me as a bank, I want to offload this from my books because whenever I say I have a loan portfolio, this is sitting on my financial statement. So it's a part of my balance sheet at the moment. Now, what my management may say is, fine, we have done this kind of lending, but we have made a certain policy change internally, and now we want to increase our capacity to lend. Now, naturally, we have already lent 100 crores, so that way our capital is locked. Now, so the management decision to be implemented. That is, if the management says that we want to go in for additional lending, that is, we want to do additional lending of 100 crores because we feel there is a large market for this. Now, since my 100 crores are already locked, I can't do anything at the moment. So as a part of securitization, what I do is I will try and offload this 100 crores away from my books. That is, I take my loan portfolio and I will sell it to the broader market. So how that is done, we'll see. But the idea is to take my loan books, which are sitting on my portfolio, structure them into a certain security and sell it to the broader market. So imagine a loaf of bread. So let's say this loaf of bread is my loan portfolio. And this loaf of bread is worth 100 crores. Now, I want to get this loaf of bread out of my bakery. Imagine that we are working as a baker. So let's say I'm working as a baker and I want to get this loaf of bread out of my bakery. So if I want to sell this loaf together, it may be a challenge because there may be very few people who want to actually purchase all the 100 crores. No one would have that much capacity. So maybe me as a baker, so this is not, so I mean, something similar sounding to baker and a banker. So me as a banker, what I would want to do is I can divide this loaf of bread into slices. So I can have slice 1, 2, 3, 4, and 5. And each of these slices are going to become tradable securities. So this is security 5, this could be security 1, etc. So imagine that my loan portfolio has been restructured in such a way that I take that restructured portfolio, I split it up into multiple parts, and I transact on each of those parts. That is, each of these parts are individual securities in themselves, and these securities can be purchased by any willing market participant. And that is how I can offload my loan portfolio, which I have depicted by this loaf of bread, by dividing this into multiple slices of bread, and each of these slices will be sold to market participants. So does this idea look okay? Okay. So this is in very crude terms as to what securitization is, how that process happens, etc. We'll see. Now, a few benefits which go for securitization is your bank's lending capacity increases naturally, because if I can offload this 100 crores, that is, if these go away, then now my management's decision to do further lending of 100 crores becomes possible, because this risk which was sitting on my books has gone away, because this risk has been divided into multiple securities which have been sold to market participants. So now a effective risk transfer has happened from my loan portfolio onto the broader market who has purchased these securities from me. So that way, my lending capacity rises. Investors also get more opportunities to invest in, because let's say a certain bank has a very good quality loan book. So maybe imagine someone like probably an HDFC Limited in India. So HDFC Bank or HDFC Limited has a pretty decent loan quality, I would say, as compared to the broader market. So maybe me as an investor, I may want to take a certain position in that book. Now, I can't do it just like that, isn't it? Because that's a loan portfolio for HDFC Bank. I won't be allowed to take that position. But tomorrow, if HDFC decides to securitize a part of their portfolio and sell it to the broader market, then that way I can take positions in those securities so that I have exposure to HDFC's portfolio, because I am optimistic that it's a good quality portfolio and there are going to be scheduled payments which investors or borrowers, I would say, borrowers are going to make to the bank. So that's why I would want to invest in that particular security. So my investment opportunities also increase. I think there's a question. So let me just complete this much, and I think there's something in the chat. Let me just go through. Would such security be sold both at a discount? Definitely. So answering Rahul's point, they can be sold at the current market price. So depending on the demand for that security, these could either trade at a discount or a premium. So that price will keep on changing. Coming back, it improves liquidity as well, because that way you have more number of market participants which are transacting, isn't it? So like me, if I was interested in the loan book for a certain bank, I was not allowed to take position initially. But now through securitization, since that is an increased avenue for me to invest, I will also become a part of the market. So just like me, there'll be other investors who would be interested. So accordingly, the overall market liquidity improves as well. Now, a liquid market is something which everyone prefers, because a liquid market is something which has its own advantages, that is better price discovery, then demand and supply can be matched in a much better way, etc. Now, all of these things are seen as a positive from the market's point of view. So that's why it also, securitization has a potential to push the liquidity up in the market as well. So these are a few benefits which I feel from the process of securitization. Now, just to show you graphically of how the securitization works. So let me just switch to my whiteboard. Now space here. No, I think this space should be enough. If it doesn't fit in, we'll see. So let's say I'm a bank. And I have my, let's say I'm big in auto loans. So imagine I've done a lot of automobile loans to the market. So, and these are my borrowers pool. So let's say there are thousands of borrowers which are sitting in this pool, and maybe my size is, let's say, same 100 crores like last time. Now, I as a bank, my management has made a decision that we have to offload these loans from our books. We don't want them on our books anymore for various reasons. So they may feel that these loans are risky for them, so they want to offload them, or maybe they want to increase their lending capacity, so they want to offload these things. So the reasons could be many. So what I do is I move these into a separate entity, which we call as the SPE or a SPV, special purpose entity or a special purpose vehicle. Now, SPE is going to restructure this thing. So SPE does the restructuring. I'll write restructure here. So restructuring of the loan portfolio happens, and SPE will create individual securities. So let's say it creates S1, S2, and S3. Imagine these are three classes of securities which are prepared. So focus only on this below portion. So just to understand what this graph or what this diagram is, I am a bank. I am very active in auto loans. So I have a large auto loans portfolio which I have advanced to multiple borrowers. So this borrower pool, imagine it's a mixed pool. So borrowers with different maturities and different amounts, etc. Because let's say if I talk of auto loan, every auto loan is different in itself, isn't it? Now, depending on which car a certain borrower decides to purchase, that loan amount and tenor will change. My interest rates will also change. So imagine there are n number of borrowers here. Total size is 100 crores. I want to offload these 100 crores going ahead. I don't want them on my books anymore for a variety of reasons. So I move these loans onto a special purpose entity. So this is a separate legal entity. So you can imagine it's a separate company in itself to which I move this loan portfolio. Then SPE can hire financial specialists or financial engineers who can do restructuring for this particular loan. So imagine that the loaf of bread of 100 crores is being transferred to the SPE. Now the activity of slicing this loaf into individual bread slices, that is something which the SPE is going to do for me. So SPE through the restructuring is going to create securities S1, S2, S3. Imagine these are my three slices of bread. S1, S2, and S3. Or broadly, you can imagine these are the three classes of slices which I'm offering. So now these classes, how exactly they are decided, we'll talk about that in a bit. But imagine that my loan portfolio has been taken. I have divided that into multiple slices. Technically, these slices are also called as tranches or slices. And these tranches are sold to individual investors. So these you can imagine are investors who have purchased these securities from me. So now effectively what has happened is the loan portfolio which I had held on my books, that has gone away. Now that has been converted into securitized products which have been purchased by investors. And I as a bank has received the money for this. So that way I am happy because my fund base has got free, because now I can do more lending. Also, the overall risk of my loan book has come down because 100 crores of loans have already got offloaded. That is, the risk which was sitting on my head has been transferred to the investors who have purchased these securities. And this is in brief a process of securitization. So any questions on this? Okay. So now, can anyone guess why do I need a special purpose entity? Now, the bank by itself could have issued these securities and sold to investors, but why this additional layer in between? So
So,
maybe some,
by separating the entity, the liabilities would transfer away from the bank towards the SPV.
correct, correct, very good. So the idea is why I create a separate legal entity is because if something goes wrong, that is, if there are defaults. So we'll talk about defaults and not defaults for a loan pool. But if something goes wrong, and if investors want to approach me, then they won't really have any claim on the bank's assets. So we'll talk. So maybe let me tell you two scenarios of default and no default, and then we'll see the significance of SP. So that will give us a better idea. So let's take scenario one, no default from borrowers. So like an ideal scenario. So imagine that the economy is doing well, the borrowers have jobs and they're able to make all of the required principal and interest payments. So finally, every borrower which is sitting inside this pool is supposed to make periodic interest and principal payments because that's a loan, right? That's how a loan works. So if the borrower is able to make, or every borrower is able to make the required interest and principal payment, everyone is happy. Because in that scenario, what happens is the cash flows which are coming in from the borrower will be paid to the bank. Now, a bank here is acting only as a facilitator. Now, bank will collate all of these cash flows and it will distribute these cash flows to individual investors because finally these securities S1, S2, and S3, these are nothing but fixed income securities. So that, therefore, these securities are going to demand certain interest plus principal payment. So that way, as the borrowers keep on making payments on their loans, those cash flows will be used to satisfy the interest and principal requirements of security holders in S1, S2, and S3 respectively. So when everything is good, everything is rosy, everyone is happy, no defaults. So no problems here. Now, in second scenario, let's say there are defaults in the borrower pool. That is, let's say the economy runs into trouble. Imagine COVID-19 scenario, and let's say many people lose their jobs, or there are maybe salary cuts, etc., which makes it difficult for a borrower to make repayments on their loans. So borrowers might start defaulting on their periodic payments. So they may either completely default or partially default. So in this scenario, what will happen is the amount of cash which is available or the amount of cash flow which is available, that gets curtailed because earlier in no default scenario, ample amount of cash flow was received which was there to satisfy the interest and principal requirements for S1, S2, S3 investors. But now that cash flow has got cut down. Because of this, certain investors might not receive the periodic interest and principal which was due to them because simply the quantum is not good enough. So there will be default. Now, whenever that happens, investors might get upset naturally because they're going to lose their investments, right? I mean, they were expecting a certain cash flow, but they didn't receive anything. So in that scenario, investors might want to approach the bank saying that your borrowers have defaulted. So we want you to make good their payments. But in order to prevent that from happening, what a bank will do is it will introduce this SPE in between. So even if the investors come back with any kind of such complaint saying that your borrowers have defaulted, so you're responsible for making good, that doesn't hold anymore. Because now investors will have a claim on only the assets of the SPE. That is, this is also what we call as a legal recourse. So something which you might have covered in your legal aspects of business subject, which you might be having one of these years. So the legal recourse which investors have, that is there only up till the SPE level. Investors cannot approach the bank. That is, investors cannot stake claim on any assets of the bank. They can only stake claim on assets of the SPE. So that is the reason why you require a separate legal entity in between. Otherwise, the bank has ample amount of resources and expertise to directly do this transaction. So they can simply drop the SPE and issue securities by themselves. But it is because of this reason that the bank will never do it themselves. They will move their loan portfolio to a separate company, which is a separate legal entity in itself. And it is that entity which will issue securities. So investors can only approach the SPE, they cannot approach the bank. And that is the relevance of having a special purpose entity. So are these two scenarios clear? Any questions? Okay. Now talking a bit of tranching. Now I think I may have to switch to the whiteboard, or fine, let me use this space. So let's say I have three tranches because I have S1, S2, and S3. So you can imagine these are the three tranches of securities. So let's say this is my senior tranche. Let's say I call this as S1. Then maybe this is a subordinated one. Let's say this is S2. And then I have a subordinated 2 tranche, which is S3. Now the ratings of these tranches are going to be different. So senior could be rated AAA. This could be rated maybe triple B. And this could be rated maybe triple C. Just some hypothetical ratings. But the point you have to note is it will be a dropping rating scale. So these are the three tranches which I have created. That is my entire 100 crore portfolio has been split into three tranches, S1, S2, and S3. S1 I call as my senior tranche. It has the highest credit rating. That is, this is the most secure of the tranches. Next comes subordinated one. It has a rating of triple B. So still on the investment grade, but it's right on the cusp. So even because we know that AAA after triple B is what we call as investment grade. So it's on the cusp of investment grade and junk grade. And subordinated 2, which is S3, is rated triple C. That's below investment grade security, as we can call it. Now, the advantage of tranching is it will allow investors to take positions in respective securities based on their risk appetite. Because every investor has a separate risk appetite, isn't it? Because let's say I may be having a very high risk appetite. So I may say I may want to purchase securities in S3 or maybe subordinated 2 tranche, as we have written. Now, someone who is very conservative, they may say that, no, we are not willing to take on any additional risk. So we want only senior most tranche. So we are interested only in S1. So that way, by dividing these tranches into different rating classifications, it improves the appeal of these securities to investors, because investors, based on their risk tolerance, are going to purchase securities from each of these tranches. Now, let's say I have this 100 crore, right? So let's say 50 crores are a part of my senior tranche. Let's say 30 crores are subordinated one, and the balance is 20 crores. So 20 crores are subordinated two. So let's say this is my total 100 crores. So 50 crores of securities as a part of senior tranche, 30 crores as a part of subordinated one tranche, and 20 crores as a part of sub 2 tranche. So this is how I divide my 100 crores. Now, as my borrowers keep on making interest and principal payments, these payments are going to be paid to these tranches in a certain order. That is, the order will be in this direction. So every cash flow which comes in, that will meet the requirements of, so when I say requirement, these are the interest requirements. So interest requirements of tranche A first, or tranche 1, the senior tranche. Then whatever excess cash flow remains, that will be used for making interest payments to subordinated 1. After that, whatever excess cash flow remains will be used to make interest payments to S3 or subordinated 2 tranche. So that is how my cash flows are going to go. And naturally, certain part of the cash flow will be used for retiring the principal amount as well, because that's how a loan works, isn't it? Now, loan is not like a balloon payment. So if you can talk of maybe mortgages. So mortgages work in such a way that you make periodic interest payments and your principal keeps on dropping. So that way, you make periodic repayment of principal. You don't make a big short balloon payment in the end. So something similar will apply here as well. So that way, firstly, your notional requirements of senior tranche are met. So interest, every tranche will receive. After that, your senior tranche principal will be addressed first. So once 50 crores are paid out, then whatever remains after that will be used for making the remaining 30 crores, which is subordinated one. After that, whatever remains will be that used for meeting these 20 crores requirements for subordinated to. So that way, this is like a priority which is assigned to these tranches, or this is the prioritization of cash flows. So be it any prepayments, etc., all of the cash flow idea doesn't change. Your senior most tranches are eligible for the cash flow first. Then comes your below tranches, sub 1 and sub 2. Now let's say what happens in case of default. So if your loan borrowers start defaulting, then that means the defaults are going to start hitting the cash flows which are due to all of these investors, which are sitting in S1, S2, S3, right? So defaults will start in this direction. That is, your defaults will be first absorbed by S3 because that is the most riskiest of those tranches, isn't it? So first default will hit S3. Now let's say the economy further deteriorates. If there are more defaults, then that defaults will be absorbed by S2 as well. Imagine the economy further deteriorates. Then finally, even S1 will start absorbing those defaults. So that way, your defaults will happen from your below most tranche to the above most tranche, whereas your cash flow distribution will happen from the top to bottom. So is the idea of movement of cash flows and impact of defaults clear? Cash flows move in this direction, defaults move in the other direction. So this is technically what we call as credit and time tranching. Time tranching basically has to talk about the payment of your cash flows, whereas credit tranching has to talk about the way in which your credit defaults are going to move. So now someone may have a question that, oh, why should I invest in subordinated 3? So what could be the reason that investors are interested in subordinated 3? Isn't that a very risky asset to invest in? Why should I take position in S3? Anyone?
So payoff might be higher.
Exactly. So these you can imagine are very similar to high yield bonds because they are risky
Could you
bonds,
please
isn't
repeat
it?
your question?
And we know that every security. Yeah, sorry, please go ahead.
Yeah, could you please repeat your question?
Oh, sorry, you want to repeat the
Yeah.
question?
Why should
Yeah, my question was, why should investors invest in S3 if it is so risky? So
All
why
right.
should I invest in subordinated 2 tranche? Yeah. So Mir answered that correctly. So that has to do with the yield on the securities. Now, naturally, the yield on securities S3 will be higher as compared to S1. That is, let's say Y of S3. Now, this will be higher than Y of S1 naturally, because every security or every asset which you look at has to be from a risk and return perspective. Now, if you are willing to take on more risk, then you should definitely be expected to receive more return. Now, investors who are sitting in tranche 3 or S3, they are definitely taking on more risk because their securities are poorly rated. They are rated triple C. So because they're willing to take on higher risk, they will be compensated by a potentially higher return, which we call as the higher yield. That's why those investors who have the stomach to digest that much amount of risk, they will take positions in S3, whereas very conservative ones will stick to S1. But naturally, their overall payoffs are going to be different. So any questions on the topic of securitization? Okay. So this is a brief on securitization. There is separate modeling which can be done for asset securitization as well. We'll not get into the actual modeling part because that becomes slightly quantitatively intensive. But generally, those of you who are interested, we can definitely discuss that offline. Now, that is something which you should not expect on your exams. On the exam, that kind of modeling will not appear. But it's a very interesting thing. So those of you who are interested, you can definitely get in touch and we can discuss further. But otherwise, for securitization, you will find multiple resources online. I'm not sure if Hull has too many things on securitization, but I think
Sorry,
even
it
if
has.
it
Hull
has,
has.
okay. So I think Hull can be a decent introduction, and subsequently you'll find a lot of content online because during the global financial crisis, this became like a notorious concept, asset securitization. Unfortunately, it's a very novel idea, but that way, because it led to the overall financial debacle, it became notorious at that time. But otherwise, it's a very interesting concept to study. And now, gradually, these kind of desks are again growing in size. So Post 2008, these desks had closed down. No one was interested in securitized products. But gradually, that is again improving because as the housing market improves, naturally, there will always be a demand for these securities. And in India, we don't really have a very active market for ABS because our bond market itself is not very developed. So that way, these are like advanced products which sit on top of a plain bond product. So that way, for developed economies, yes, you will find these kind of securities being transacted. So in America as well, you'll see the volume of these securitizations which are going up gradually. Now, hopefully, the financial crisis which had struck back in 2008 should not repeat because the market has also learned a lesson. So they are also putting the required amount of safeguards in place, and they are also much more careful this time. So hopefully, even even if things do go wrong, they should not go that wrong. So, but only time will tell. All right. So we can take a quick break for like 5 minutes, and we can come back. So it's what, one, close to 12:50. So should we meet at 1 o'clock and we proceed, and then we'll continue for half an hour more.
Sure, sir.
Yeah. Yeah. Okay. Hi guys, can we start? Is everyone back?
Yes, sir.
Okay. Okay. So talking of central counterparties, so have you guys studied CCPs in any other subject, or when it's a CCP or a central clearinghouse? So was this discussed in any of your other subjects as well? So whereby maybe you might be introduced to exchanges. So in that context, was a CCP discussed? Okay. So CCPs, or what we call as central clearing houses, are those entities which play a very important role in providing clearing and settlement of transactions. Now, when you say a normal trade, now a trade cycle has a clearing and settlement which is an integral part of that. So when a front office trader hits a transaction, that is just one portion of the entire trade. Now, there they freeze on terms and conditions, the price, etc., and all other things which are relevant to the trade. But after that, there is a process which follows, which we call as clearing of that transaction and the final settlement of the transaction which happens. So that is something which a CCP facilitates. And through clearing and settlement, the CCPs try to reduce the credit risk which is embedded in the transaction. So credit risk mitigation is something which a CCP is going to facilitate. And most exchanges will have their CCPs, or other, I would say every exchange has their own CCP. So take NSE, BSE, or any other foreign exchanges as well. They'll have a entity which provides the clearing and settlement of transactions. That is what you call as a CCP of a certain exchange. Now, when you talk of clearing and settlement from a bonds perspective, so especially if we focus on the Indian market, have you guys heard of CCIL, Clearing Corporation of India Limited? Are you familiar with this entity?
Yes, as mentioned before.
Correct. So CCIL is something which plays a very important role, especially in the fixed income space, and they provide clearing and settlement for FI, FX, and OIS type of swaps, which you call as overnight index swaps. So if we do get a chance, we'll discuss some bit on swaps, but we'll see how time permits. But CCL provides the guarantee for clearing and settlement of a certain set of transactions, and fixed income happens to be one of those transactions which CCP provides support on. So for this, CCP has two systems which are offered, which you call as NDS or NDS OM. So NDS is negotiated dealing system. Negotiated dealing system. So a very, very popular technique which is used by market participants whenever they wish to use the CCL platform for clearing and settlement of transactions. Because the idea is whenever you have a CCP in between, the chances of default are close to nil because they are there to guarantee the clearing and settlement. So every trader might want to use the services of a CCP. So NDS system is something which will allow you to do that. So let's say I am a trader and so let's say I work with a certain bank and I want to purchase a certain bond from some other bank. So there is a trader who is sitting in another bank. So let's say I am bank A and there is a bank B. I want to buy and B wants to sell. Let's say we are talking of certain bond. Let's say a certain corporate bond which I'm interested in. Now, I as a buyer will communicate with the seller in bank B, and we say that. So I'll tell them that I have such and such a requirement for the bond, so I would like to purchase the bond from you. So that way, me and the trader in bank B are going to decide on the terms and conditions. That is, what is the price, also, and other specifications which are specific to the trade. So maybe which broker services we want to use, what is the notional value of security, or what is the total face value of bond which we wish to transact, etc. All of these things we decide, and then our transaction happens. That is, on a trading level, the transaction is complete. So from a trader's or front office perspective, they can say their job is done. They have struck a trade. So me and my counterparty, we have agreed on to certain terms and conditions. And again, this is mostly agreed on the phone. So after talking on the phone, these have to be converted into a form of a note. Oh, sorry, my screen is not being visible, is it? Did I share screen? Is my screen visible now? Okay.
Yes, sir.
Oh,
It is.
okay. I think some error. My apologies. I did not realize that there was some issue. Okay, so we are on this NDS point. So I am A and I have a bank B. We have agreed on a certain bond and I have purchased the bond from them. So what I do is after discussing with the trader at bank B over the phone, we prepare our contract notes. So I'll prepare my note 1, or maybe I call it a note A, and trader B will prepare a note B. Now, these notes will be passed to our respective back offices. So my note A will go to back office of bank A, and this will go to back office of bank B. Because finally, whatever I discuss over the phone has to be converted into black and white, isn't it? Because this has to become a legal transaction. So yes, I mean, your phone discussions in trading houses are recorded, because whatever you discuss in the front office, that will be on a recorded line. But you require a documentary evidence for a transaction. So that's why a note has to be prepared. So that contract note will have all of the specifications of the things which have been agreed, which are given to our respective back offices. Now, what the back offices do is they will take these notes and they will send it to CCI. So these go to CCI. Now, CCR is going to match these two notes which are received. So all the terms and conditions which are given in note A will be matched against note B. Now, if there is any kind of gap or mismatch in these notes, CCR will immediately communicate the two parties saying that we observe a mismatch. So you have to immediately resolve the differences so that we can proceed with the clearing and settlement for your transaction. Now, if that happens, then the counterparty have to resolve any differences. So they may have to go in for certain documentary evidence, which we say phone records. So they would like to go through the phone record as to what was discussed and then accordingly make the required changes in the notes and again resubmit it to CCL. Once CCL finds that these two notes have matched, then the transaction goes through. That is, me as a buyer will receive the securities from B and my bank account will be debited. That is, payment will get transferred from my account to counterparty B's account. And this is how a normal NDS system works, or what we call as a negotiated dealing system. And this is how market participants try to use a CCL platform, which provides the clearing and settlement services, because clearing and settlement of transactions can be a headache for counterparties. So if you have a certain external party who is willing to take on that risk and who is willing to guarantee such clearing and settlement, everyone would like to use those services. So that's how CCL comes into play. So this is what you call as a negotiated dealing system. So any questions on this?
Sir, what is the role of depositories in this? Or they are based on trade? Sorry, are they on the trade side of?
So depositories are basically those entities which are going to hold those securities in a dematerialized form or in a demat form. Because as we know, just like shares, even bonds are going to transact in a demat form. So for that, you require depositories. So every trader will have, so when I say every trader, every bank will have a depository account. And any kind of transactions which happen will happen through that depository account. So your securities will be debited or credited to your depository account, whereas the actual cash will get credited or debited to your bank account. Then there is another type of system which is available, which we call as NDS OM, which is negotiated dealing system with order matching. So that OM stands for order matching, NDS OM system. So again, another system which is supported and provided by CCR for market participants. Now, NDS OM system is very, very similar to what you observe for your equity transactions. Now, many of you might be transacting in equity shares. So if you open up your internet trading account and if you see the way in which a certain transaction happens, so there you see there is a concept of order matching which happens. So anyone here who trades often, or maybe who trades for a long-term investment in equities, Or maybe do you help your parents with those transactions?
Yes, sir, I do.
Okay, okay. So you may be familiar with the idea of order matching here. So whenever you place an order in for, let's say, now imagine that I want to purchase, let's say, 5 shares of Tata Motors. So what I do is I go into my trading account. I decide whether it's a limit or a market order. I input the number of shares and I place the order. So once that order is placed, that will go to the exchange. So imagine that I'm using National Stock Exchange as my exchange for transactions. So if you double click on that particular security's name, so depending on whichever trading platform you use, you'll see the market depth. So when you say the market depth, you'll see the list of buyers and sellers. So when I say list of buyers and sellers, not the names, but you'll actually see the volumes and other things which are relevant to the purchase of a certain security. So you'll see the buy and sell orders being accumulated, and these will keep on updating every minute because as market participants trade these securities, these buy and sell columns will also get continuously updated. So that will tell you how much is the demand or supply for that security. Something similar gets repeated for the NDS OM or order matching as well. So imagine that I want to purchase a bond. I place my buy order inside NDS OM. Now, then what CCR will do is it will try to match my buy order against various sell orders which are there for this particular trade. And whenever it finds a matching sell order, the transaction goes through. So that way, an NDS OM system operates. And NDS OM is very, very similar to generally what we do for our equity transactions. So that's why I took the example of equity, because most of are familiar with the equity side of things. So NDS OM, you can imagine, is just a fixed income counterpart for whatever happens on the equity side. So is everyone familiar with the idea of, so since you're talking of equities, so are you familiar with order book, trade book, etc.? What do you mean by these things? So have these terms been covered in any of your other subjects, or maybe are you aware of these things? So imagine that I have placed, let's say I have placed a limit order for purchasing 5 shares of Tata Motors. So I say that I want to buy 5 shares of Tata Motors at X rupees each. So imagine this is my limit order. So how exactly does this limit order work with my order book and trade book? Anyone? So it could either be a Zerodha or any other trading account which you guys use. Okay. So whenever I place such an order, this goes and sits inside my order book. Since it's a limit order, so is everyone familiar with the difference between a market and a limit order?
Yes, sir.
Okay. So
Sir,
that,
before that, I had a doubt.
yes, please
Sir,
go.
for example, right now the Tata Motors share price is 434. Okay.
Okay.
So, sir, my friend, sir, suppose I have placed a sell order of say 500,
Mhm.
and sir, my friend places the say buy order of 500 for equal amount of shares. So, sir, with this concept, my shares should get sold at 500 rupees price, but this doesn't happen.
This won't happen because it's the market price which needs to be met at that time. Because it's not just you and your friend who are the participating entities, right? There are other more number of entities which are there as well. So exchange is going to collate all numbers and then it will try to do the order matching. And that order matching will happen at your market price. So as the market price moves, your transaction can go through. Otherwise, if that doesn't happen, then everyone will want to transact at a favorable price, which is not possible.
Okay, sir.
So the idea of order book is the moment I enter an order, so if it's a limit order, imagine that the price is different than 434. Then this order will go and sit inside my order book. Only when my target price is reached will the transaction happen and the order will move to trade book. So that way, all of the orders which you place will stay in the order book and then they move to the trade book. Even if you have a market order, for a fraction of a second, that order will sit inside your order book and it will immediately pass through. So if you observe that for a few seconds, you'll observe it inside the order book and then it will vanish. Then it will go to your trade book because that trade will go through. So your actual transaction where it happens gets recorded as a part of the trade book. Whenever you're simply entering orders to be executed, they will sit inside the order book. So again, something which you'll observe as a part of your internet trading accounts. So idea of novation, or I would say, or maybe you can relate bilateral settlement subsequently. So when I say novation, I'll give you an example of this so that you'll understand novation. So let's say entity A, entity B. Let's say you have a CCP in between. So bilateral netting versus, so I should actually put this as a divide. So I can either do it bilaterally or via novation. This is through a centrally cleared one. Okay, so let me give this maybe as path 1. And let's give this as maybe small x and small y, and we'll say x plus y is path 2. Now let's say A and B are two transacting parties and they want to transact on some security. Let's not worry about what security it is. Now there are two ways to do things. Now they can either trade directly. Imagine it's a OTC market, something like a bond market which you're looking at. So A and B can directly transact with each other, that is through route 1. So if they do it through route 1, that basically implies that the entire risk of clearing and settlement will be the responsibility of A and B. So if something has to go wrong, either A or B, they have to manage the default risk or a potential credit risk which is there in the transaction. Because in path 1, CCP doesn't come in. CCP is not there. So that way, there is a significant amount of risk which will be carried on path number 1. Now, this is what you call as a bilaterally settled transaction. So when you say bilateral settlement, why bilateral? Because there are two parties which are involved and which are managing the clearing and settlement cycle. Now, in this case, parties A and B are managing the bilateral settlement. And that's why this is called as a bilaterally settled transaction, which is path 1. Now, let's take path 2. Now, I say path 2 is a combination of two segments, X and Y. So now let's say A and B say that we don't want to transact with each other directly, but we want to use the services of a central clearinghouse or a central counterparty. So what they do is they approach a CCP and they use the services of the CCP for doing this transaction. So that way, counterparty A will see CCP as its counterparty, whereas party B is going to see CCP as its counterparty. That is, CCP is becoming a buyer for every seller and it is becoming a seller for every buyer. Now, that way what happens is this transaction is broken into two parts, a trade between A and a central clearinghouse and a trade between B and a central clearinghouse. Once I combine those two sections, they are exactly equivalent to 1. That is, finally, 1 is exactly equivalent to 2. Only thing is the way in which we are approaching trade or path 2 is different because we have introduced a central clearinghouse in between, which is guaranteeing the clearing and settlement of transactions. That is, the credit risk, which was initially held by A and B, that has been transferred onto a central clearinghouse. So any kind of potential default which is to happen, the central clearinghouse will be able to manage that. So that way that risk gets mitigated. And this is what you call as a centrally cleared trade. And this is an example of novation. So path 2, which I've shown here, this is an example of what we call as a novation. Now, why novation? Because here we are creating something which is new. Novation, the grammatical meaning is creating something new. Now, we have trade 1 and we are splitting this trade into two parts, X and Y. So these are like new parts which you are creating, right? These did not exist initially. So that is why this is called as the process of novation. So whenever you have a centrally cleared transaction, you follow the process of novation. But for a bilaterally cleared one, that is not required. So this is the difference between a bilaterally settled transaction and something which is a centrally cleared and settled transaction. So any questions on this? Okay. So just a couple of points and we can stop for today because we have just discussed quite a few technical bits today. So maybe we'll complete these 3 points, we'll stop. So request you to bear with me till then. Now, talking of payment systems, so there is a DVP mechanism which follows, which is delivery versus payment. So when you say delivery versus payment, that means the exchange of securities and exchange of cash, it happens at the exact same instance. It should not happen that securities are being delivered and your counterparty defaults. So whenever a CCP operates, it always operates on a DVP or a delivery versus payment mechanism. So you pay with one hand and you receive with the other. So something similar as we quote in Hindi movies, ek haath se dena and ek haath se lena. So that's the exact same idea for a DVP. A few CCPs which are globally used. So popular ones, again, you have a CCIL, then every exchange has a CCP. Then you have LCH ClearNet, you have Euroclear, and even large global exchanges which provide clearing and settlement services. But again, the main idea remains essentially the same. That is, we are trying to mitigate the amount of credit risk which is there in the transaction. Because whenever a CCP gets introduced in a trade, it guarantees the clearing and settlement, which is a very important part for any transaction to go through. And that's why every transaction which happens on a CCP is assumed to be free from the risk of credit default. And that's why globally you will observe that there's a growing trend of moving trades onto a CCP. So any questions on this? Okay.
No, sir.
Okay. All right. Okay. So we can next one. Okay. Reform. Now reforms are going to take some time. So maybe this will take close to 20 minutes more. So let's not talk about reforms right now. So maybe when we meet on one day, we'll complete interstate benchmarks and then we can start something new because I'll not be able to complete it in 5 minutes. So that is something which we'll discuss maybe at the start of our Monday class and then we'll start with something new. So in the next week, request you to be ready with your VBA bits. We'll do some VBA programming in the next week. So maybe after we discuss forward rate agreements, we can do some hands-on, which is based on the discussion which we had over the last week. So idea around bootstrapping, etc. That is something which we can quickly try out. So request you to just brush up VBA. So I had mentioned a resource the last time, Excel VBA for Dummies. That's a decent enough resource. So if you have even some basic idea of VBA, that is good enough. Now, how exactly do you use that in a certain model? That is something which we'll see when we actually do our hands-on. So anyways, we'll do the hands-on together. So you'll have an idea of what exactly we are doing. So that is something which we'll try to do maybe in our Wednesdays or next Saturday's class. So before we depart, allow me to take your attendance. So do you guys have a session after this also, or this is the only session?
So we do have another one.
Okay. Okay, so starting with economics. Akash Singh is present. Achal Jain. Ayush is present. Adesha Hati.
Present, sir.
Tejas Akware. Ali. Anjali Garg. Anmol Sen. Aristita Deka. Avni Mishra. Ayushi is present. Sarvesh is present. Bhavya Dang. Hari Chabra.
Present, sir.
Diksha Chauhan.
Present, sir.
Present,
Dipansha
sir.
Singh. Gaurav Kadam,
Present, sir.
Gaurav Datir, Himanshi Verma is present. Jaideep Saini, K. Ayushi,
Present, sir.
Riya Shukla,
Present, sir.
Kriti Marwa is present. Mansi Singhal,
Present, sir.
Mansimran Arora,
Present, sir.
okay, Manvi Kukreja is present. Mihir is present.
Kriti
Muskan Garg,
present. There was some internet issue.
sorry, who is this?
So Kriti Marwa.
Yeah, I have marked you present. Yes.
Okay, thank you, sir.
Namrata Gaur, Neil is present. Nikhil Agarwal,
Present, sir.
okay. Okay.
Present,
Pratik
sir.
Sharma, Pratik Maheshwar,
Present, sir.
Rachit Tyagi, Rahul Ghosh, Rahul Giri, Rahul Goswami, Rajaditya,
Present, sir.
Rashi Jain,
Present, sir.
Rishabh Kothari,
Present, sir.
Ruma Keshri, Sahaj Manocha, Samiksha Chopra, Sharanya is present, Shubham is present, Shubham Kumar is also present. Shubham Kumar is not. Sobeshwar Verma, Suti Mehrotra is present, Sanika Thakur is present, Vinaya Pawar. Okay, so we are done with economics, so you guys can leave. So I'll just take the attendance for IB.
Thank you, sir.
Thank you. For the IB class, Ayush Sharma is present. Alisha Gupta, absent. Vidhi is absent. Anand Jain is absent. Anish is absent. Anjali Sethi is present.
sir.
Arshada Imam is also present.
Yes, sir. She's
Yeah.
present.
Barka Israni, Bhavya Patel, Saloni is absent. Chaitra Tirodkar, Devam Pandey, Diksha Kalra, Auraja Nevatia,
Present, sir.
Gayatri Narkede, Govind Dittal, Sawan is present. Himanshi Veermani is present. Indu, Ishita Saxena, Anika Goyal, Atik Mittal, Asro L, Lakshya Singhal, Mahi Rajawat, Ansi Gupta, Pathangi Warrior, Megha Parak, Nancy Halawat, Neha Jain, Pratishtha Pradhan, Rohan Bagai, Rohit Potar, Samida Malik, Shivangi Semwal, Simran Pahuja is present. Srishti Verma,
So
Manu Goyal.
Simran is present.
Yeah, Simran, I marked you present. Yeah. Tarang Kadyan, Kadyani Todkari, Twinkle Karnawat, Vaishnavi Stotriya, Vanishka Jain, Vibhor, Vidushi Rana is present.
Yes.
Yash Mehra. All right. So thank you so much. Thanks for joining in, and I'll see you guys on Monday. Thank you.